Jan, how, in your opinion, how has the development funding landscape changed so far this year, and where are you seeing the main gaps and demand from developers?
Yeah, sure. I actually think it hasn't changed much, and it needs to change, to be honest. I think the market, if you look at really from a big overall pictures, it's remained the same. Like you have the high street banks who have left this market, development finance. Then the basically choices for property developers are either a challenger banks, which are probably a bit cheaper, but they're more risk averse. They have less appetite for risk. And then on the other side, you have mostly unregulated bridging companies, which are, it's a very big market with a lot of players, so a very fragmented market, but very inefficient market. So that's why we have a strong view that this needs to change to something more efficient and more transparent, and probably regulation will be the solution.
Do you see that going across the bridging and development space?
Yeah, probably both. I think, yeah, they probably treat it about the same way. It's probably even worse in pure bridging than development because there's no barrier to enter this market. So a lot of lenders, even high net worth or ultra high net worth, are entering this market as lenders. There's no entry barrier really to the markets.
Yeah. Well, we've definitely seen a huge rise in bridging lenders in this space over the last few years, and even during the pandemic, which was quite surprising. In your opinion, how will the appetite towards risk in the development funding space change throughout the rest of this year? We've obviously seen some kind of movement in that, since the beginning of the pandemic.
Yeah, it's true. I mean, clearly, when you had the start of the lockdown, when COVID started, kicked in end of March last year, you could see every lenders were reducing their loan to value, loan to GDV, which makes sense because there was a massive macroeconomic risk with the lockdown. So you had to reduce your parameters to mitigate for that risk. Clearly, the property market has performed. Probably surprisingly, if you are looking at it as beginning of last year, you would thought it's not going to perform like that. But the market has done really well, which is great for the market. There's as well a lot of liquidity out there. For sure, you were talking about more players coming into the market, but I think there's definitely more cash coming into development finance and bridging because people, every type of investors are looking for yields. But I still think while the parameters and the appetite's gone up again, I think lenders still remain cautious because you might see a bit of volatility in the next couple of years, unlike the last 10 years, because there's still a lot of uncertainty. I mean, with what's happening now and the spike in demand everywhere, there's potential for inflation coming, and we really think here inflation is to come. And then what does that mean in terms of interest rates? If the interest rate goes up, then the property market, obviously on one side, inflation is supportive, is a good support to the property market, but rates going up is clearly very negative. So that can create some volatility. And the more volatile the market is, the more cautious lenders are going to be. So I think if you look at the headlines, you're going to see loan to value back lenders landing back to the parameters they were pre-COVID. But, and it's a big but, I think if you look into the details, lenders are overall a bit more cautious than pre-lockdown because the environment has completely changed.
Mm. And as a result of that, we're obviously seeing some kind of gaps in the market on what developers are acquiring in terms of funding in the development space, especially in commercial. What areas are you seeing that are most underserved currently?
So I'll say first is on the loan size. The higher you go on the loan size, the more service it is. The lower you go, the smaller project is, the less service it is. And then for sure, the most service product is going to be the pure vanilla residential product. If you start looking, you said commercial, I think after this crisis, clearly It's more difficult for developers and get bridge on commercial asset than it was before. And if you look at residential, when you start looking at student accommodation or HMOs or micro flats, all those type of products, there will be less lenders keen to do it than the pure vanilla product that everyone wants to do. But I think more than the product is really on the loan size. You look at a development above 20 million, you get like 20 million pound loan size, you get a lot of institutional money out there. When you go below that, you get less, you might get more players, but small amount of money. And the lower you go, the less players there is. So if you look at the new build development finance sub £1 million, there are really very little amount of players who lenders who fund those projects.
Would you say that's more of the mid market that rather than the low market, like sub 1 mil?
Yeah, I mean, I think it's gradual. The lower you get, the less service it is.
Do you foresee that changing over the next 12 to 18 months, or do you think that's going to stay quite stagnant in that space?
The problem you have is the very small project wants to pay the same kind of rates and fees as the bigger project, so it's less attractive for the lenders, and that's the problem. I think for this to change, the fee structure has to change on like sub £500,000 project compared to £500,000 to £1 million, and then £1 million to £5 million. And really, when you look at the markets, it's almost the same pricing at the moment. So to attract more lenders, I think you want to see those smaller projects to probably to pay more fees or more interest, but overall to have a higher cost. Otherwise, every lender that grows and they want to do bigger and bigger project to deploy their capital quicker, and it's more efficient for the lenders as well.
What's the kind of loan size that Blend is looking at currently, kind of on an average basis? Like where do you currently sit?
Sure. So our sweet spot is probably £1 to £4 million today. That's where we do most of our projects. But we start about £200,000. Officially, we go up to 5 million, but we start looking now at bigger projects as well, on case per case.
And how do you think a fragmented development lending market, which we've kind of talked about already, how does this impact on transparency in terms of what developers are kind of seeing and what they're getting?
So yeah, that's what we're talking about. I think the market is extremely fragmented. You have loads and loads of lenders, but most of the lenders are relatively small lenders compared to a bank with massive balance sheet, like a massive high street bank to lend. So the problem is, and I think it's back to what I was saying, is because of the regulation, there's not regulated markets, there's a massive lack of transparency. And we see it every day. You can issue terms. I'll give you an example where we will be lending at 9% with roll-up interest. Another lender might be at 8.5% with retain interest. And sometimes, because the market is inefficient, if the broker is not presented to his customer in the right way, the 8.5% might look more attractive, whereas it's more expensive. Because on the retain interest loan, you're going to pay interest on your interest and fees on the interest you're borrowing. So the market is really inefficient. You would think with a lot of players, it makes the market very competitive, which is great for the property developers. But I don't think it's the case today. I think with the lack of efficiency and transparency and kind of standardization of terms issued by the lenders, it makes, I mean, it's not presented in the right way to the client, to the property developer. So we think one way to solve the problem is really have some regulation coming into the market and making sure. I mean, the bridging market, let's be honest, doesn't always have a good reputation. I think it's for two reasons. One is probably the rates are high, but there's a risk associated to it. So that's acceptable in a way. But the other way is because the lenders are not committed to till completion, till the end. We heard a lot of times lenders who changing their terms during the process, or increasing the rates or the fees, have some admin fees or monitoring fees on top of the QS fees that are not being transparent, and the borrower wouldn't expect that. So it creates a bit of frustration and sometimes a bad reputation to the market.
Absolutely, and I think that is something which definitely needs to improve on. And as you say, this standardization in the market is just a huge lack of it across both development and bridging, and that is, you know, purely based on the fact that it's the majority of it is unregulated.
Mm-hmm.
Blend obviously got regulated, you
Mm-hmm.
got authorized by the FCA, not quite recently. How do you expect that regulation, that FCA badge, so to speak, to evolve your business? And will you be introducing any different offerings as a result of that?
Yeah. So about the regulation, we think it makes a big difference, and I think the main difference is really into the culture of the company. I mean, we have governance in house to basically make sure what every originator is saying to the clients, and make sure we are completely transparent. We're monitoring the conflict of interest, and end of the day we cannot behave like I would say like the terms cowboys that you see sometimes in the market. We're being audited. We're much more transparent. We cannot hide our fees. It's really about the culture, how we do business, how you process business, and if we don't behave properly, there's two things. I mean, we could be in trouble with the FCA, or even fined, and our clients can even complain to the FOS. So how you behave when you're regulated is very different to companies. When they are unregulated, they can do pretty much what they want, and that's what creating sometimes a bad reputation to the sector. Regarding the products, I mean, our basically main products is what we call our blend loan, which is typical development finance loan. Is an 18-month facility, which is 12 months to build plus 6 months to sell. So we have this 18-month facility where we roll up the interest. We don't retain the interest. Because we know property developers, quite often they can be late to deliver. Doesn't mean the project is not happening, but things can happen and they can be late. We really try to create a product that fits the demand, what they need. So on every loans we do, we offer them a 6 months free extension. That means after 18 months, they haven't completed the project, but obviously we can see the progress. Some delayed may have happened at month 3 or at month 9. So we give them an extra 6 months where it's a free extension. That means the interest rate is the same. There's no legal fees. There's no administration fees. It's all pre-agreed from day one. And all they have to do is service the interest in the last 6 months to make sure our loan to value, loan to GDV doesn't go up. But yeah, that shows really our intentions really to create a product that fits the property developers, rather than we see in the market. We're quite shocked sometimes, like 12 months products for a property developer. That's, I don't know how you can literally build and sell within 12 months. And the game is, we see often, is people are looking to make more returns on default, on penalty rate, on default rates, charging more the property developer. And that's not at all the game we're in. So we're always offering usually like those 18 months plus always a 6 months extension that the developer can decide to use or not. And if they don't use them, we're not going to charge anything for it. So it's like a free option really for them. One thing we've very recently added to the blend loan as well is a top up. So we've partnered with a family office where they can increase our loan to GDV. So our typical product is 68% loan to GDV. So it's a very stretched senior loan. But the family office, which is all pre-agreed, will top up an extra 5% on the loan to GDV. That means we can extend to 73% loan to GDV. And the great thing for the client is it's all packaged. We all package it. So we have pre-agreed terms with the family office. The intercreator deeds and all is already pre-agreed. They rely on our due diligence. So it's not like, the problem is when you have too many, when you have too many solicitors involved with too many counterparties, literally everyone keep trying to add value. Each solicitor try to add value and talk for, and then you can extend, basically, you can take an extra month or two to complete on the loan. So the fact that we really partner with that family office, we package the loan, so it's literally almost seamless to the borrower. We just offer one package. We show them the blended rates, and they can decide to add these extra meds or not without having had the headache of going through all the loops to get it done.
Does that the family office funding them to on top, is that junior debt? Is that like a mezzanine facility, or do you actually blend it as one kind of stretch senior product together?
Yeah, so it depends really on the loan amounts. It depends. If it's a kind of small project, they're happy to come junior, and we just have one facility. If it's a bigger amount, they may want to take med security just to get extra security. But technically, we organize everything. They don't really interact at all with the other lender. We take care of it basically.
Makes sense. I understand that Blend's on track to double its lending this year. What has caused this surge in business for you guys?
I mean, the team is growing, to be honest. That helps a lot, and we've built, I think, a very good reputation and kind of brand in the market. So now we're seeing relatively, I mean, we've been around for 3 years now, a bit more than 3 years. So we're seeing more and more borrowers now that are repeating. So they finish their project and wants to work with us again. So that helps us growing the loan book. At the same time, we're seeing more and more people calling us and saying, "Oh, I've seen you've done that deal around the corner from my development," or "I spoke to that developer who's done a deal with you and say good things about you guys." So that helps us as well growing the loan book. And on the broker side as well, our panel of brokers has grown quite a lot as well. So that helps us really scaling our business. We literally have a lot of capital to deploy. So it's really about growing that relationships with brokers and property developers to build our business and grow our business.
And you've mentioned a few things already about your offering, but what other changes can brokers expect from Blend later this year?
Yeah, so what we've been doing to date and we keep doing is, one is growing the loan size. I mean, as our loan book is growing, we always growing our loan size, maximum loan size. And this, we want to keep doing it. And I think the next step is really, and what we've done actually last quarter, and we want to do it again, is try to bring the interest rate down. What you see in development finance, I think, is the rates are quite expensive because access to liquidity, even you have a lot of players, is not that easy. If those high street banks were involved, that would bring billions back in the market. There's a lot of players, we said, but it's a lot of small players. Relatively, 50 million, 150 million. It's not a huge amount of money compared to a huge balance sheet coming to the market. So I think the rates should compress, and that's what we're trying to do as well. Is trying to be as much as we can, always more and more competitive, and that drags the interest rate down. And we think that's the key thing. Obviously, a property developer now, the challenge is to source the right deals, but the cost of funding is not cheap. Whether you go to a challenger bank or an alternative lender, it's never cheap. So we think with pushing the rates down makes more projects viable.
Are you looking to obviously try and do that? Are you looking to attract more investors to the platform? And is the FCA regulation that you've recently got, is that securing you more interest from investors?
I mean, to be honest, on that side, it grows exponentially, and we always have way too much capital. As we grow the loan book, the capital we have to deploy grows faster. So I'll say most of our time we spend now is purely looking to originate more. Capital is not an issue, and there's a lot of capital out there. We cannot accept all the capital that's coming to our door at the moment, and that's probably because we have a good track record as well. I mean, our loan book is 100% performing. We had 2 loans that were late during COVID, and now they've repaid. So we have a very strong track record. So capital is not an issue, and it should not be an issue if you have the right track record in this environment. Interest rates are very low, and I mean, finding capital to me is not the issue. I think at the moment things might change. in the long term, but today is the challenge is finding the right deals, I think.